Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Iachini, and I'm a cross-asset strategist from the CIO team. On today's episode of the podcast, we'll discuss what to make of the latest developments regarding the Fed's tapering plans. We'll take a look at Europe's earnings reporting season, but also discuss whether default rates in China are accurately reflected in the bond markets. Joining me today for this conversation, I'm glad to welcome Manpreet Gill, Head of Fixed Income, Currencies and Commodities. Now, without further ado, let's start today's conversation. This week, the Fed meeting minutes showed that most policymakers want to start the tapering of bond purchases by this year. Should investors be worried, Manpreet?
Hi, Marco. Look, it's natural for investors to be a bit concerned. I mean, tapering in many investors' views, does mark a point where policy starts getting a little bit less supportive than what we witnessed for quite some time now. But to be honest, in our view, we're not so concerned. It's very well possible that markets could face a bit of a wobble when policy shifts, but we'd be happy to buy into any such dip. And I think there are three reasons why we sort of retain this comfort level. I think first and perhaps most importantly is that the Fed, if it does start tapering, it's really starting from a position of strength. And to put that in perspective, we've seen obviously the run of strong economic data. Some of those positive surprises have reduced, which is natural, but in an absolute level, many of these data releases are still at very, very strong levels. I mean, witness the ISM survey numbers, for example. At the other extreme, you've seen, the US job market data. At the current pace of job gains, it's quite likely the U.S. unemployment rate falls below 5% by the end of this year. And to put that again in perspective, the last time the Fed started tapering of bond purchases, all the way back in 2013, the unemployment rate was much higher at 6.9%. So position of strength, clearly, if we go into tapering. The second point is that the Fed will clearly retain the option to alter the timing and pace of tapering. So an announcement and a startup process is one sort of factor, but even within that, there's nothing to say that the Fed can't adjust that pace depending on how incoming data and market sort of sentiment plays out. So that's a bit of a safety valve. And third, and I think also important to note that tapering is not the same thing as hiking interest rates. I mean, there's a lot of discussion about how higher interest rates and bond yields could be a riskier assets like equities. But even if we start tapering, that means, interest rates don't start rising until, at least beyond a year from now. So our view is that over the next year, at least, that means policy rates remain below the inflation rate. And in our minds, that's still supportive of continued outperformance of equities over bonds. So I think overall where that leaves us is that, there are a couple of dates coming through that are important. So the Jackson Hole Summit next week and the September FOMC meeting. And it's possible we may see a bit of volatility, following, those events if a tapering announcement is made. But I think our point is that, if we do see any such volatility, we'd be quite happy to buy into that dip. And as many of you must know quite well now, our preferences, if we do get that dip in the equity market space are for Europe and US equities, and in the fixed income space, that's really for emerging market, Asian, and developed market high yield bonds.
Thank you, Manpreet. Now, if we can switch gears a little bit, in the prior episodes of the podcast, we talked about the US earnings season. What I wanted to talk to you about today is the European earnings seasons. What are your key takeaways, and what are you seeing right now from the numbers that have come out?
Well, the overall earnings season is turning out to be quite positive in Europe as well. So I'm going to throw a bit of a wall of numbers at you, but hopefully those help quantify just the extent of positive surprise we're seeing. So the big headline is that overall earnings have surprised by 24% to the upside of the 80% or so companies that have reported already, and within that, we've seen 65% of companies, actually beat earnings expectations. And what you're seeing from those sort of positive headline numbers is that we're seeing expectations for the rest of this year also being revised up. So on a full year 2021 basis, before the earnings season started, markets were expecting a 46% rise in earnings. Now, today, almost all the way through the earnings season, that number's gone up to 56%. So overall, it's a very positive set of numbers and clearly strong positive earnings surprises coming through. When you go sort of one level below that, we're seeing a similar level of positive surprises from a sector perspective. So when you look at our preferred sectors, which are financials, energy, materials, and technology, we've also seen positive earnings surprises, ranging from anywhere from 13 to 27% so far. So a really, really positive set of numbers. But I think from an investment perspective, there are two big takeaways. I think one is that it supports our preference for Euro area and Euro area plus the UK. So European equities. To a 6 to 12 month horizon. I think that's coming through, being supported by the headline numbers, but also from a sector strategy perspective of 4 preferred sectors, also displaying very strong earnings growth. And I think those sector focuses, we think still look attractive today for investors looking for a sector-based strategy.
Understand. Now, if we can talk about one more thing before we end today's podcast, and that is China and the regulatory crackdown. In recent days, in recent weeks, we've seen worries about bond defaults spiking in a way. And what should we make of this? Are bond defaults in China something to worry about, and how do they impact the Asia bond market as a whole?
So I think it might help to break that question down a little bit. So rising bond defaults are something it's natural to be concerned about, and I think it's always a good sort of mindset to have when thinking about bond investments. But what I do to sort of answer that question is break it down to three components. I think the first question that's important here in this context is we've got some regulatory tightening. Are we close to the end of that, or is that likely to continue for some time? And actually, that's a pretty hard question to answer because we don't have a lot to go by, unlike traditional fiscal or monetary policy. But whatever history we have suggests, this is not a flash in the pan. Regulatory tightening could continue for a few more months, particularly since much of this sort of fits into some broader policy goals of Chinese policymakers. So not something that might go away, overnight. The second question is, okay, how does this specifically translate into default risk? And I think the key here is looking at balance sheets. And the risks here do differ a little bit by sector. Now, we've seen a lot of scrutiny on the technology sector, but at least as far as bond markets are concerned, balance sheets are pretty strong. So we'd be less concerned about defaults. Now, this risk might be somewhat greater in property and SOE sectors because balance sheets are relatively weaker in this space. But that at least gives a little bit of direction in terms of where to focus on a default risk. And finally, possibly the most important thing is to say, look, we've got these risks, but there is a price for everything. And the question is, what are markets pricing today relative to the risks that are out there? And I think what's really interesting is that when you sort of try and look at current Asian dollar bond valuations, particularly in the high yield space, in our view, at least, they're pricing in a double-digit level of defaults, which is usually the kind of levels we see during recessions. And again, just to place that in context, leaving aside the last recession in 2008, 2009, usually default rates in Asian dollar bonds have in the region of below 5%. So clearly a high default rate is priced in. So I think when you pull those together, I think where it leaves us is that, look, these risks from regulatory tightening, it may not be something that goes away immediately. But what's really interesting is that the market's pricing in quite a high level, and we think an excessive level of defaults. And I think that's why, regardless of the policy outlook, at these levels, we'd actually be quite comfortable adding to Asian dollar bonds, particularly in the high yield space, because we think markets are now paying you fairly well for the risk you're taking on.
Great. Thank you, Manpreet. That was very clear. So thanks again, and Manpreet, and thank you for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thank you for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.